You've probably seen the ads: build tax free wealth while you sleep, borrow against your policy anytime, tax free, guaranteed growth plus a death benefit that pays your family. Life insurance policies, such as whole life variations, are taking social media by storm. To be fair, it's hard to ignore ads that are promising the traditional benefits of life insurance, like a death benefit, while also promoting growth potential and loanability of the underlying. It is important to realize these are not simple tools like term life insurance. These are complex vehicles that are more expensive and should be evaluated carefully before and after purchasing. We're going to dive deeper into this subject, but my hope is that you'll realize that while these complex vehicles can be advantageous for specific situations, they do not make sense for the majority of people. Thanks for taking the time. My name is Eugene Hoover. Let's get started. Term life insurance is a simple product. You pay a fixed cost for a fixed death benefit over a fixed number of years. This policy type tends to be great for temporary liabilities, such as a mortgage, a child's college needs, or a needed income stream that would disappear upon your death. This policy type is cheap and can often be purchased for up to 20 years of protection. There are, however, cons to this policy type. When the policy term ends, you may have difficulty qualifying for another policy due to your health or age. The other large con is that at the end of the term, if you are still alive, the policy disintegrates along with the premiums that you paid. There are reinsurance and roll options available, but these often require more expensive riders and upfront agreements. Now, enter whole life type insurance. Whole life options have been around for hundreds of years. Your parents probably still have a policy today. They were sold on the fact that you pay a fixed premium every year, the cash value grows at a guaranteed rate, your policy never lapses as long as you pay the premiums, and tax-free loans are possible. Now, this sounds good so far, but you need to realize that the guaranteed growth is often much lower than what a well-managed investment portfolio can do for you, potentially. Especially considering the internal fees. For the average family trying to save for college or retirement, that extra premium could have been invested elsewhere with potentially significantly more growth potential. To be upfront, whole life is becoming harder and harder for me to recommend. Today, there are much better alternatives. With that said, whole life may make sense if you are very risk averse, you require a guaranteed death benefit indefinitely, and are not reliant on compounding interest for successful retirement. I did mention that there are better alternatives to whole life, so let's talk about indexed universal life, or IUL policies. Now, this policy is not appropriate for everyone. It has internal fees, requires annual premium payments, and has annual growth potential caps. For most people, after you do your annual IRA and or 401k contribution, you're done saving. And for those with extra savings, it can often make sense to put assets into a taxable brokerage for future needs and tax strategies. But there are households who have great incomes and have run out of places to save money. Even after upgrading their 401k to a profit sharing and cash balance plan, some business owners still have additional cash that needs a home. These are the same people that tend to be in a high tax bracket. Now, IUL policies start to look very attractive. Aftergrowth dollars into an IUL grow tax-free and give you the ability to tailor your death benefit for both estate planning needs and future cash flow needs. If you are buying the IUL as an income source in the future, it essentially becomes a super Roth. And for those of you that will be in a high tax bracket in retirement, this type of policy can save you a ton in taxes. These are also the same people that tend to have significant estate planning needs, who can leverage the tax-free death benefit. In summary, complex insurance policies have internal fees and limited upside. For someone who is just looking to save for retirement, there are less suffocating growth vehicles. For those that have already maximized those vehicles and are looking for other ways to save money or solve a legacy need, take a look at life insurance options.